Have you ever wondered what will happen if your bank defaults? You probably have, and likely came to the conclusion that you shouldn't have to worry because you have less than 250,000 US dollars or 100,000 euros, and thus it is guaranteed by the government. But have you ever wondered what would happen if, for example, the biggest bank in the US would fail, or let's say multiple banks fail at the same time, and how that would affect you? Probably not, right? I mean, that is unthinkable. That is a fantasy world, right? Well, today I'm going to dig very deep and I'm going to try to answer this question. So, are you ready? Let's go. Alright, so to begin with, let's go back to a very dark period in the US history, which was the Great Depression. According to this article, between 1929 and 1933, the quantity of goods and services produced in the United States fell by 1/3, the unemployment rate soared to 25% of the labor force, the stock market lost 80% of its value, and some 7,000 banks failed. So you can imagine the horror that these people went through, and if you want to have a good understanding of how that daily life was during the Great Depression, I would highly recommend reading this book. I'm not sure if you can read it. It's called The Great Depression Diary by Benjamin Ruff. Again, it explains how daily life was in the eyes of a lawyer. I've read it quite a while ago, but it's very, very good book. It's a very good read. Now, I believe this book is very relevant for today's video, because as I've mentioned before, a lot of banks failed or had bank holidays over the weekend and then still went bust. Now, what happened to the savings of these people? Well, there was no such thing as a deposit insurance. If a bank failed, you lost the money you had in the bank. So you can imagine the horror that these people went through. So to avoid this horror all over again and to remain the trust in the banking sector, President Roosevelt took office in 1933. And as part of his New Deal, he introduced the Banking Act, which established the FDIC, right, the Federal Deposit Insurance Corp. We still know it till this day, but then of course with a higher deposit ceiling of 250,000 US dollars. Now moving on to the financial crisis, a more recent episode, what we mainly saw were bank bailouts, and these bailouts were funded by the taxpayer. Of course, this caused a lot of anger, and therefore a change was needed. So Congress passed the Dodd-Frank Wall Street Reform and Consumer Act in January of 2010. And what did it do? Well, it basically closed the door for bank bailouts, but it opened the door for bank bail-ins. And what is a bank bail-in, you may ask? A bank bail-in makes the bank investor responsible for the cost of restructuring the bank. And this sounds very good, right? Until you realize that you, the depositor, are the new bank investor. So in a bank bail-in, your deposits are forcibly converted into shares of the bank. And since your bank is defaulting, they are practically immediately worthless.
Whoa! This is worthless.
Now, these shares are not covered by the FDIC. So you didn't lose your deposit, you lost your investment. But yeah, that's basically the same, right? Now, we saw one example of a bank bail-in occurring in Cyprus in 2013. Depositors lost 47.5% of their savings, exceeding 100,000 euros. Again, depositors received these worthless shares and lost around 4 billion euros in total. Now, as I've now explained, we already know the answer to our question, what will happen if our bank defaults, right? So the part that gets built in, the part that is not FDIC insured, yeah, that's the part you lose. Now, in my opinion, what is more interesting is whether the part that is indeed FDIC insured is really that safe. It first and foremost depends on what bank you are at. Now, for example, if a smaller local bank defaults, it won't be that much of a problem, right? The FDIC has enough funds to just pay out everyone with funds lower than 250,000 US dollars. But again, you will lose the amount that is above the 250,000 mark. Now, if let's say a bank like JPMorgan fails, then of course we have a bigger problem. And before I go into my own analysis, this is what a Motley Fool article has to say about it. Senator Jerry Moran asked one of the only relevant questions of the hearing. He wondered if JPMorgan failed, then could it go down without costing taxpayers money? The answer was also the most telling. Yes, Diamond replied. The timing couldn't have been better. The day before, a JPMorgan internal assessment of what it would take to push the bank into bankruptcy was released. The conclusion, a loss of $50 billion US dollars. No need to worry, the report assures. After failing, the bank could be hosed down, cleaned out, and returned to private sector as a new bank with a clean balance sheet. Taxpayer money used to keep the bank operating in the interim would be repaid, the report promises. Everyone lives happily ever after. The article, however, very much doubts that. I mean, when you think about it, JPMorgan is the largest US bank, okay? So if, let's say, the largest US bank would fail, that would have complete catastrophic consequences for the entire US economy. And this is what this article is going to explain here. Credit markets would freeze. As the financial system ponders who's holding the bag, everything stops and credit grinds to a halt. Anything not called US Treasuries is deemed too toxic to touch. Even the bluest of blue chip companies suddenly can't access credit markets, and thousands of businesses around the country that rely on credit to fund inventory and payroll go bug-eyed. Nobel Prize-winning economist Robert Solow described this in 2008. So businesses that would normally be investing in a new computer or a new fleet of trucks or whatever that would need to borrow can't borrow. And if they could borrow, they would be paying a very high rate of interest, so they stop. And then the real economy begins to slow down and people lose their jobs because their firms can't sell to consumers, can't sell to other businesses, right? And I would have to agree with this article, right? Some economic shock might happen, or maybe some bank fails, or maybe, right, JPMorgan has a trading loss of $100 billion. Something like that could happen, and it would cause an enormous systemic collapse. And in addition, it's also a psychological game, right? It's also based on trust, because if JPMorgan can make it as the biggest US bank, then who can, right? And this will cause a complete panic and also undoubtedly a lot of bank runs. These days that would be called silent bank runs because everything is digital. And what I wanted to find out right now is, let's say this scenario plays out and everyone makes a run for it on the bank, on JPMorgan. Does the FDIC has enough money to pay everyone their deposits back, right? That's what I wanted to find out, and I came to this calculation. Now, over here I have the annual report of JPMorgan for 2021. Of course, it's a bit outdated, but it's still pretty good reflection, right? Okay, so for 2021, they have $2.5 trillion in deposits. Okay, now what we should ask ourselves right now is what part of that is not FDIC insured? So what part of that is above $250,000? And by the way, if you're wondering how much $2.5 trillion is, that is 15% of GDP. Okay, so we're talking about big numbers here. Now over here I have the JPMorgan's balance sheet. So liquid assets are $1.7 trillion and their deposits are, in this case, $2.3 trillion. I don't know why that's different. Maybe it's just a bit outdated. Okay, so but doesn't matter. Now when we go to the notes, we see that of those liquid assets, only $700 billion is actually cash, and the rest is just stated as liquid or some form of liquid instruments. However, times change, and for example, during a period like the Great Depression, where all banks are scraping for cash, it's not as easy to convert your liquid assets for cash. Okay, so let's imagine that in such a scenario, they are only able to extract 50% of those liquid assets into cash, meaning that is 500 billion US dollars. Then 800 plus 500 is $1.3 trillion. Now, to fully pay out those $2.3 trillion in deposit, it means they need an extra $1 trillion. Again, what part does the FDIC need to cover? Everyone with deposits of less than $250,000. Of course, I cannot know for sure since JPMorgan will never share the data of their clients, but we can make some sort of estimation. So this is what this site of the ECB tells us. I quote, "However, substantial disparities persist. In the third quarter of 2021, the top 10% of the wealth distribution held around 45% of total deposits, while the bottom 50% only held 17%. Now let's assume that that also holds for JPMorgan. Now according to CNBC, the average savings of all households of the top 10% is $1 million approximately. So that would mean that if these people are sort of complete idiots and put everything in one bank account, the part that is above $250,000 would not be FDIC insured. And again, remember, this is the part that will be used for that bank bail-in. Again, since these people hold 45% of total deposits, and again, we assume that that was also the case for JPMorgan, it would mean that 3/4, right, or let's say the part above $250,000 of the 1 million, right, $750,000, so let's say 3/4, times 0.45 times 1 trillion means that 337.5 billion is not FDIC insured and 662.5 billion is. Now, of course, this is a conservative number because in reality what people will do is they will put their funds or their deposits over multiple banks, or maybe they have joint account ownerships. That's also possible, and that means that the FDIC has to insure even more. So according to the FDIC, the DIF balance, right, this is sort of the funds that they have to pay off these deposits, the DIF balance has risen every quarter since the end of 2009 and stood at a record 119.4 billion. Okay, 119.4 billion, but we just saw that we needed around 600 or 700 billion dollars only for JPMorgan. So how is that possible? Well, it's not possible, right? And that's why I'm thinking to myself, isn't this just based on trust, right? Is this entire sort of scheme, isn't it sort of a Ponzi scheme, right? Isn't it sort of just like a currency, like a fiat currency? Isn't it all just based on trust? Even if JPMorgan was able to sell all their liquid instruments for cash, it would mean they have $1.7 trillion in cash. That would mean that they still need $600 billion. And again, if we do the mathematics, that would mean that 202.5 billion is not FDIC insured and 397.5 billion is. Again, the FDIC still does not have enough money. So what would happen in reality if JPMorgan would fail? Well, they would probably borrow from other banks that are still solvent, or they would borrow from the government, or maybe the government has to print the money, and that would be fine. But what would happen, let's say this really dark scenario where multiple banks fail at the same time? Well, obviously the government does not have enough money, right? So they would have to borrow it from somewhere. Now, since every government has the same problem and they can't obviously borrow from the private sector now, and they also can't raise taxes, right? That's just something that they're just not going to do in such a scenario. It means the central banks have to print the money and thus monetize the government debt. Well, we all know what will happen to the inflation numbers when that happens. And you are probably wondering how likely this worst case scenario is. Well, of course I don't know, and I'm probably happy that I don't, but I think it is much higher than most people think. First of all, a large black swan event like war is always present. And then you also have, let's say, a large trading loss that was mentioned before that could also trigger such an event. And then of course we still have monetary policy. You see, it does not really matter what the Federal Reserve does. If it keeps increasing interest rates, it means a recession is guaranteed and people will lose their jobs and thus cannot repay their loans. If they lower interest rates again and do QE again, it means that inflation will go up and people will lose more purchasing power day by day. And eventually they will also, in such a scenario, also not be able to repay their loans. AKA, in both scenarios, banks are completely screwed. And something that is also very worrying is that the FDIC has prioritized the payment of bank derivatives above all other creditors. Under this resolution, derivatives are a secured liability, so the FDIC will pay derivatives first. And if you think about the fact that banks hold trillions and trillions of dollars in derivatives, the argument that the FDIC can pay everyone back becomes even weaker. And finally, I want to end it with some advice. Don't put all your money in one bank account, especially if you have a lot of money, but also if you don't have a lot of money. Diversification is always helpful, whether that is with stocks or with other financial assets, or whether that is simply by diversifying your bank accounts. Banks at the moment are well capitalized, but that will massively change once we go into this major recession. Then people will demand their money, but these banks will just not give it to you. I mean, go to the bank right now and demand a withdrawal of $10,000 in cash. Trust me, that will take you a lot of hassle to get that cash, especially if central bank digital currencies will be implemented and cash will simply stop to exist. And then they will have complete control over us. You will simply be unable to reach out to that, and everything will be centralized by the central banks. But that's it for today. I hope you learned something today. Please let me know what you think about the current banking system, whether banks are resilient or maybe that they're not really looking at certain scenarios like I think. Feel free to subscribe or like or whatever, and I'll see you around. Bye bye.